the one asset that held up best in that time period of the traditional stock, bond, cash type things. Bonds were a disaster, of course. They were worth zero. But cash held very, very short. I mean, almost rolled over daily, weekly, whatever, kept best pace with the runaway inflation. So it's an interesting, unexpected result of his study. Longer fixed income, of course, would be the worst assets that you could have in a severe inflation. Investments likely to benefit from deflation. Top quality fixed income securities with no threat of default. And that might be hard to come by, but nonetheless, that's what you would be looking for in a deflationary environment. Possibly the US dollar, unless our financial system itself were endangered. The dollar would become dearer in a situation of deflation. Precious metals could get hit along with other asset classes in a deflation, but they could also rise if the overall financial system became endangered. So it's they're a maybe on the deflationary side. Let me have you go. Whoop! We lost the graph on the. That's all right. There are not just price parallels there, though. That's the thing that I wanted to point out. In the 1990s, when Japan was coming first off its peak and having its problems, Japanese central bank, with a little bit of a lag, ultimately dropped interest rates essentially to zero. As many of you know, they also didn't recognize the debts of the really badly situated banks. They rescued the banks. Contrast that with a number of the smaller Asian countries that ran into their crisis in the late 1990s. Most of them took a much tougher stance, recognized the deficient banks, ultimately allowed much of that problem to fail, recognizing it, letting it fail. Interestingly enough, those which are more emerging markets are doing far better today. Japan, as this shows you, is still, stock market's still 75% down from its peak. Interest rates are still near zero 20 years later, and they still haven't recognized the problems of their banks. The unfortunate thing, by way of potential parallel, is that that's what we're doing. We brought our interest rates down to zero. We're not recognizing the bad debts of the banks. We're in fact subsidizing their survival. Moral hazard runs rampant. So it's a very, very difficult thing. We certainly hope that the parallel is not the same for the next 10 years, but we're doing some of the same stuff, which is not encouraging. Okay, current conditions and forecast. We're right about the time where we should be calling it quits, so let's wrap it up fairly quickly. This is what, if you look at the next page, unlike the last seminar, most of this graph, which is the current S&P 500 over roughly 13 months or so, most of this is in an uptrend. So we're seeing a nice bounce off the March bottom. That's in fact been about 60+% to the high. We've had a little decline here in the last 2 weeks or thereabouts. And the one thing I would point out here, just by way of what's coming in the near term, who knows, but potentially, the momentum lines down here sometimes can be helpful and indicative of a change of trend. If you look here, when the market was declining, the low here and the low here, you could draw a line going down that way. At the same time, however, the momentum lines reached a bottom way back in here, and then even though price went lower here, this momentum is starting to get a little more positive. So those are never good, I mean, forecasters that next Thursday it's going to turn and be better. All it does is say that the potential for change is in the neighborhood, perhaps. And we see, in fact, that was a pretty good indicator there that was coming somewhere near an end. What we're seeing now is obviously a bit of the opposite. We're seeing the price run up here. We are seeing the momentum decline some. So we're not seeing the momentum confirm the price movement. That doesn't mean anything has to happen right away. It's just saying that the strength of the move appears to be waning, at least by that measure. If you look over to the next page, you'll see this all in a longer-term context. You'll see where we are right now. The price, even though we've had this dramatic rise, we're still a heck of a lot away from below our long-term peaks here. We're at about 1998's price level, and we're still down about 30% on the S&P from those highs, both in 2000 and again over here in 2007. On the NASDAQ down below, we're down at about 1998, 99 price levels, and we're still down about 60% from the high back in year 2000. Despite the recent recovery, valuations on common stocks are still extreme. Price to earnings ratios on the S&P 500 for what are called as reported earnings, which means GAAP, GAAP approved, generally accepted accounting principles. GAAP earnings show you a price to earnings ratio in the 90s for the S&P 500. It's extreme. Even if you rule that out and say, okay, well, it recognized all those huge losses in the fourth quarter of 2008, even if you rule that out and you look at operating earnings, you're still up in the 20s for a price earnings ratio. And if you look at all the other price twos, price to book value, price to dividends, price to sales, and so on, they are all historically high. In fact, most of them are higher than ever before in history, except for the prior decade, which is, as we know in retrospect, a bubble decade. I mean, it was at levels that made no fundamental sense. And if you look over to the, yeah, you're there at the next page already. That's what foresight does for you. Here you have the earnings yield on the Standard & Poor's 500. It's the reverse or inverse of the price to earnings ratio, which is price divided by earnings. The earnings yield is earnings divided by price. Okay, well, on an earnings yield basis, going back into the mid-1920s, we've never seen this before. The earnings yield is minuscule, and it will come up some. The fourth quarter of 2008 was a total disaster. We will move past that, at least for year-on-year figures, when we get the end-of-year figures here, but it will still be very, very low. This down here is the dividend, and you can see, if you go left from here, this is the level of the dividend, all the way back 80-some years, you don't hit anything except this bubble decade, which, as I say, we know in retrospect made no sense. So right now, what are you buying if you're buying stocks? You're buying no yield, no earnings yield, and the lowest dividend in history other than a few crazy years. So what are you buying? You're buying hope. You're buying hope. You're buying faith that the government will find a way out. And maybe it will. But what it takes to put money into stocks at this level is a great deal of hope. You're making a bet that the government will win. And you're paying, by historic prices, you're paying extremely high amounts of money to make that bet. We don't know if that bet will work out or not. But you're making that bet in a very dangerous environment. Page 37 shows a very important graph, I would suggest, for the near term. Through a good part of this decade, we've had a confluence of asset markets move together. Stocks, frequently bonds, which don't always work together, gold, silver, for a good part of the decade, real estate. They've moved opposite the US dollar. As the dollar has weakened, they have strengthened, and that certainly has been true in the period since March, where the dollar reached a peak, and it's been going down pretty consistently ever since. Right now, there's almost a unanimous opinion that the US dollar is going lower. And there is a very high consensus that those other asset classes are going to continue higher. Worldwide stocks, gold, silver, what have you. That could happen, certainly, but a rising dollar, which would surprise a lot of people, could lead to a real upset of the apple cart. Because right now, I mean, if the dollar First of all, nobody believes the dollar is going to go up. So when you get everybody on one side of a trade, you're vulnerable to a shift. You also are starting to see a little bit of stabilization of the dollar down here. And I'll use these momentum lines